And you don't need to be the brain of Beijing to actually understand what that does to the value of the dollar.
Mhm.
Okay, so what are they doing? We have got this capricious President Trump who runs around and sort of starts, basically destroying America's dollar by running around, putting tariffs on everybody, changing his mind every 5 minutes, etc., etc., etc. What did that do? But we can see how this is going to happen, Tom. The first thing, we're already seeing strains, the liquidity strains, okay? So the Fed starts cranking up the presses again, just as they did in 1922 in Germany. Believe it or not, before that happened, the Reichsmark just really in 1922 was the best performing currency in the world. It rose against the dollar, which was the equivalent of gold in those days. It rose to the point, like it doubled against the dollar.
Mm-hmm.
This is quite remarkable. And then, of course, later on in the year, it started declining again. But it came to the point where the bubble got popped, the stock market bubble got popped. The stock market had risen 300% from February 1920 to December 1921, 300%. It then started declining, and it lost in Reichsmarks, which were beginning to fall in their purchasing power significantly at that stage. It fell by something like a third. But as I say, if you measured in gold or dollars, which were the same thing then, at 20.67 to the ounce, it was, well established, then it lost literally 93% top to bottom. And that was by around about, from memory, I think we're looking at around about middle 22.
Mm-hmm.
So it was a sort of, 4, 5, 6 month wonder. Not pleasant. Now, our credit bubble equally is going to get burst.
Mm-hmm.
And it will get burst either because it runs out of momentum or because bond yields start rising again. And I notice they are beginning to rise again, having sold off. Already, the valuation difference between the long bond and equities means that the valuation is now so stretched, it's more stretched than it's ever been in history, meaning that equities are more expensive relative to bonds than they have ever been in history.
Mm-hmm.
So, some stage, that's, like a bit of elastic is going to snap. And we don't know at this stage quite what's going to snap it. My guess is rising bond yields will do it. We're already seeing little bits of trouble coming through. Bitcoin, for example, has now lost, nearly 20% of its value from the top. It's losing momentum. It looks bloody awful on the charts. And the importance of that, of course, is that it correlates very, very nicely with the Magnificent Seven.
Mm-hmm.
It's the same cohort, if you like, that have been buying the Magnificent Seven that have been buying Bitcoin. So you can see that what Bitcoin is telling us is that there's trouble, if you like,
mm-hmm.
In the momentum stocks developing. There may be, now, we're going to see this liquidity injection easing things as far as the market is concerned in the short term. So I'm not ruling out one last spurt
mm-hmm.
in the equity market on the basis that this easing of liquidity is likely to fuel yet more buying of equities. I think that's quite possible, but that's a very short-term thing.
Asset prices can rise far beyond fundamentals, but momentum always breaks eventually. During Germany's early 1920s boom, stocks climbed more than 300%, then collapsed violently. The key lesson: markets built on artificially low interest rates and overextended credit do not unwind gently. Today, analysts see stretched valuations everywhere, from tech giants to speculative crypto assets. The gap between long-term bond yields and equities is now one of the widest in history, a signal that something must soon correct. Investors call it the elastic band effect. The further it stretches, the more violently it snaps.
And I think at this stage, anyone who's in the equity market is actually at very, very high risk, very high risk. Could go up another 10, 15, 20% by March next year. I wouldn't rule that out, but I wouldn't bet on it. No way. You never get the top in a credit bubble. If you do, it's just pure chance. Don't talk, and chartists who say that, I'm terribly clever, I can get the top. My Elliott wave theory says that it's going to go wherever. Forget it. It's a nonsense, absolute nonsense.
Alasdair, obviously, there's, as you explained in the Weimar example, that there's ups and downs, there's different starts and fits to this this process.
Yeah.
So if and when we do get this credit bubble pop, do you think that let's say the run to safety and liquidity pushes a lot of people into the dollar, which increases demand and price of the dollar?
No. The problem here is that if you look at the Treasury tick figures, foreigners own roughly $20 trillion worth of equities, US equities. So you got to think, what are they going to do once the bubble pops? They're going to get hell out of equities. What do? Just put it on deposit? No, when things go wrong, it won't just go wrong in US equities. It will be going wrong in equities around the world. So from a practical point of view, if you are managing a portfolio, say in Germany, for German clients, you're going to sell the foreign stuff, not your domestic stuff. So this is the problem, I think. You'll find that foreigners are stampeding out of the dollar. The interesting thing is, and I think the question really, which I think a lot of people will have on their lips, is how will this affect the gold price? Will it mean that people take profits in gold? I don't think so, because gold is under-owned. Now, I wouldn't say that the establishment might not be tempted to mark prices down, but I think they would run into buyers if they did. I think where the danger lies more is probably in mining stocks. They will be sold because I know they're not widely owned, but the few people who are fortunate enough to own them as part of a portfolio. They've already got, the Magnificent Seven, AI stocks, all the rest of it. They are bound to, try and sort of offset the losses by taking profits on their mining stocks. So I think the mining sector could be hit harder than, say, gold or silver.
A credit system can break in two ways: by losing speed or by hitting a sudden obstacle. Rising bond yields are now one of the biggest threats. As borrowing costs climb, inflated valuations lose support. Bitcoin, once the symbol of liquidity excess, has already fallen sharply, mirroring weakening momentum in the so-called Magnificent Seven mega-cap tech stocks. Over the short term, fresh liquidity injections could still trigger another rally. But that final surge would be the most dangerous of all. History shows the most euphoric highs happen just before confidence collapses. Timing the peak is nearly impossible.
There has been a big shift, I think, in the Chinese authorities' approach to silver. I mean, in the past, they've basically accumulated silver. They have controlled the price. I mean, the suppression of the silver price, I put down to the Chinese. I mean, I think in 2023, they supplied, I can't remember the figures, but I mean, something like 200 million ounces or something, figure like that, to the West. And the interesting thing was that they supplied it to London, they supplied it to Hong Kong, they supplied it to Singapore, and I think there was somewhere else. I mean, these are all financial centers. These are not manufacturers. In 2024, the financial centers came out of it, and it was supplied more to countries like India, who manufacture solar panels and all the rest of it. I think it's probably stopped now. And if you look at the Shanghai Futures Exchange, the vaulted silver there has dropped very substantially. I'm told that the view is that if it goes down close to 500 million ounces, then we've got real trouble.
Mm.
Well, it's going that way. So, and interestingly, I mean, we wake up in the morning here in Europe and find that gold and silver are going better during Hong Kong's trading hours or Shanghai's trading hours. And we're trying to put a lid on it. That, as you can see today, I mean, we were up to what on gold we were up to what 4,020. And this afternoon, guess what? It's drifted back to something like 3,980. So, the sellers, and they're not serious sellers at all. I think they're managers, if you like, rather than sellers, managed to get it done by something like $40 off the top. We'll see what happens overnight again. I mean, there may be a bit of profit taking because obviously ahead of the weekend, I mean, the Chinese are wild punters too. I mean, when it comes to futures and things like that, they may well take some profits ahead of the weekend. So we might see some more weakness tomorrow. I don't know. But the underlying situation is that the stuff is running out of the vaults, and sooner or later, there's going to be a huge great conflict between the physical market and the paper market.
Many assume that during turmoil, investors flee into the US dollar for safety. But this time may be different. Foreign institutions hold roughly $20 trillion in US stocks, an unprecedented exposure. In a global crash, overseas investors will likely sell American assets first, repatriating funds and reducing dollar demand. Instead of strengthening, the dollar could weaken sharply as foreign capital rushes home. In such a scenario, precious metals often become the only neutral store of value not tied to any one government. Which raises the question, where does gold go when trust in currencies evaporates?
The problem really with assessing what China owns is that they're very secretive about what they have bought, if you like. And, I don't know the answer. I really don't know the answer. So what I've done is I've tried to work out on the information that we have what the answer is likely to be. My starting point in this was that the regulations appointing the People's Bank of China with the sole responsibility for acquiring the nation's gold and silver date from 1983. Now, it was at that time, I mean, Mao died in 79 or thereabouts. There was a massive inward investment going into China. And certainly from the early 90s onwards, the trade surplus was beginning to rocket as a result of all the factories that were being built in China by American corporations, mainly, and to a lesser extent, European ones. So, I mean, at the same time, we had a bear market in gold. I mean, a huge, great bear market in gold. And so this was an ideal time for the Chinese to pick up gold in particular. Silver was a slightly different thing. That was done in a different way. But I reckon looking at those foreign exchange flows, which again were the monopoly of the People's Bank of China. So, I mean, they were handling both paper and physical, paper currencies and also physical gold, physical money. I reckon that just putting 10% of those flows across their desk, foreign exchange flows across their desk, into gold, meant that by 2002, and I'll come back to that date in a moment, by 2002, they'd accumulated somewhere between 20 and 25,000 tons. Now, of course, at the time, the official reserves were something like 300 tons, and they raised it to 600 or something. 2002 is important because that was the date when the Shanghai Gold Exchange opened and members of the public in China were allowed to buy gold. Since then, if you look at the withdrawals from the Shanghai Gold Exchange, they total nearly 28,000 tons. Now, that is gross, if you like, because some of that would have gone back into the vaulting system. Because, if you're going to scrap gold goes in, even if it's bars, physical bars which have been taken out. Everything that goes back in is scrapped and re-refined into 4/9 kilo bars.
Gold ownership today is surprisingly low among Western investors, yet rapidly expanding in the East. China, in particular, has shifted strategy. After years of contributing silver to Western financial hubs, supply has increasingly been redirected toward industrial users in Asia, especially India's massive solar manufacturing sector. Vaults in Shanghai are being drained at a notable pace, bringing physical inventories closer to critical levels. Meanwhile, gold withdrawals on China's exchanges suggest strong accumulation behind the scenes. Should physical shortages collide with speculative short selling in Western futures markets, a dramatic price revaluation could follow, led not by Wall Street, but by Asia.
Oh, they arrived at the right answer, not necessarily through sort of education I would condone, but by chance they've got the right answer.
Mm-hmm.
And this informs not the Chinese who've been subsequently trained in Harvard and all the rest of it. I mean, there's you've got a whole generation, if you like, who've had this knocked out of them substantially. But the wise heads in actually running the Communist Party still understand this, and they see it because they're playing a geopolitical game apart from anything else. Mm-hmm. And they understand that when they beat America back out of controlling the whole world, that the use of the dollar is going to decline. And you don't need to be the brain of Beijing to actually understand what that does to the value of the dollar.
Mm-hmm.
Okay, so what are they doing? We have got this capricious President Trump who runs around and sort of starts, basically destroying America's dollar by running around, putting tariffs on everybody, changing his mind every 5 minutes, etc., etc., etc. What did that do? It drives everybody into arrangements which exclude America, because America is an unreliable trading partner. And so you remember, I think it was April the 2nd, when he was holding up these boards saying, China 50%, whatever it was, the whole thing turned out to be meaningless rubbish. But the first thing that happened was the negotiations between Japan, South Korea, and China to have a trade bloc between them were accelerated. The second thing that happened was that President Xi had a whistle-stop tour around Southeast Asia, going to Cambodia, going to Vietnam, going to Malaysia, going to Thailand, whatever. He had a week of talking to these guys. These are the, if you like, the core of the ASEAN free trade area. Yeah. We're looking at a very substantial network of populous nations. We're talking about quite a large element of GDP. That's being free trade. So in other words, what we're seeing is that China moved immediately to counteract the danger, if you like, of President Trump. They have more or less insulated themselves from it. And indeed, if you look at their exports to America have declined, but at the same time, their exports around the Shanghai Cooperation Organization and also BRICS have increased. They are not nearly as dependent on America as they were. And this is planned. It's as simple as that. So the next thing that happened, and I'm sure this was all part of what President Xi was saying to the various presidents when he did his whistle-stop tour, was we will open vaults outside China so that you can exchange gold for yuan and vice versa.
Mm-hmm.
China's leadership has spent decades preparing for a world less dependent on the US dollar. From the 1980s onward, the People's Bank of China quietly accumulated gold, while foreign investment fueled massive trade surpluses. As geopolitical tensions rose, tariffs, sanctions, unpredictable policy shifts, China accelerated regional trade agreements, strengthening alliances across Asia, BRICS nations, and the expanding Shanghai Cooperation Network. Their next strategic move, establishing global vaulting and settlement hubs where gold can be exchanged directly for yuan. The message is clear. The dollar's monopoly on global trade is weakening. A new system is emerging, and it is anchored to hard assets.